Nixon took us off the gold standard. Right? The world continued to accept the dollar as the reserve, despite the fact that it was no longer backed by and redeemable in gold, which was the only reason it became the reserve currency. It was because we had so much gold that Bretton Woods agreement, we were able to have the dollar as the reserve currency. But we went off the gold standard, but the world continued to accept the dollar as if it were still backed by gold. Well, the significance of what's happening now is that the world is now going off the dollar standard. They should have done it back in 1971, but they didn't. And that's what enabled over 50 years of this, service sector bubble economy to be created, where we will able to live beyond our means, consuming what we don't produce, borrowing what we don't save, thanks to the reserve status of a fiat currency that we created out of thin air. These guys made fun of me because I missed Bitcoin on the way up. I did. I missed it on the way up, but I'm also missing it on the way down, right? They're going to catch it on the way down. I think the majority of people who made money in Bitcoin are going to end up losing money in Bitcoin because they didn't sell. The ones that got in really early and cashed out, yes, they're going to go home winners. But the vast majority are going to go home losers. In fact, Bitcoin was the best performing investment when hardly anybody owned it. But, the minute Wall Street embraced it, 2021, and, they started launching ETFs and stuff like that, from its November 2021 high, Bitcoin is now down more than 50% priced in gold. More than 50%. So people who sold their gold to buy Bitcoin ETFs have lost a tremendous amount of money. Even though Bitcoin has gone up from then, it's gone up a lot less than gold. But soon it's going to actually be lower than it was back then. Bitcoin was 69,000 at a peak. And now, it's above it. It's, 90,000 or something like that. But it's going a lot lower than 69,000 very soon. In fact, right now it's at 89,440. So the same people that made fun of me, for my advice against Bitcoin, they're going to have to eat those words as well. Of course, CNBC, they don't even have me on anymore, so they don't have to deal with it. They don't have to apologize. In fact, I was watching today, some people come up and they talk about gold. Although, interestingly enough, the lady that was interviewing this guy who was talking about gold, she kept saying, but you wouldn't say buy it now, right? I mean, wouldn't you tell people to wait for a pullback because it's gone up so much?
Financial media treats gold differently than stocks or technology. When equities surge, commentators cheer momentum. When gold rises, skepticism dominates, calls for pullbacks, hesitation, and delay. Yet gold's role isn't speculation, it's protection. Central banks understand this distinction, which is why they've been accumulating gold at record levels. Dollar diversification is no longer theoretical, it's operational. Even mainstream outlets now discuss de-dollarization seriously, though they once ridiculed the idea. The irony is striking. The same arguments dismissed years ago are now presented as cautious consensus, just without acknowledging who warned first.
Like, I never see them say that about the stock market. Like, well, you wouldn't tell people to buy the stock market now, right? It's just gone up so much. Shouldn't they wait for a pullback? No, they never talk about waiting for a pullback when it comes to tech stocks. But no, don't buy gold. You better wait for a pullback. Look, yes, it's better if you could buy a pullback, but what if it doesn't pull back? I mean, if I didn't own any gold or silver right now, I would be buying it today, right? I mean, shame on me for not owning it and letting it go up this high without buying it. But, you can't just keep waiting for a pullback that may never come. Or if it comes, you won't be quick enough to snap it up, or you'll be waiting for a bigger pullback and you'll miss out, right? So, but the interesting thing is she was so skeptical. But they didn't give this guy who was bullish. He was talking about the story of de-dollarization and central banks getting out of dollars and getting into gold. They didn't give him shit for it. They didn't make fun of him. They didn't, like they used to do for me. So at least they're taking people seriously now when they mention it. But they should have taken me seriously. Again, the first time I was on CNBC with Mark Haynes, and I've talked about this clip, I went on and gold was, $300, $400, something like that, $400. And I came back a few months later and it was $450. And I said, look, gold's up $50 since the last time I was in the studio. And then Mark Haynes says, who cares? Why should I care about the price of gold? What difference does it make? Yes, he's the anchor on a financial news station, and he doesn't care about gold, which is the most important financial commodity that there is. And of course, had people just bought gold the very day that Mark Haynes said he didn't care about it, they would have beat all the things he did care about. The stock market, which he cared so much about, was outperformed by gold.
Decades ago, gold quietly outperformed the assets financial television celebrated most. Anchors dismissed its relevance, even as it steadily proved its value. Gold doesn't rely on earnings growth or financial engineering. It reflects confidence, or lack thereof, in monetary policy. Those early warnings weren't about short-term price moves, but long-term stability. Today, gold's resurgence isn't sudden. It's overdue. What's changed isn't gold, it's trust. Trust in currencies, fiscal discipline, and political restraint is eroding, and markets are responding accordingly, even if the commentary still struggles to catch up.
Yet, he didn't give a damn about the price of gold. Now, I told him, I said, well, you should care about it, and one day you will care about it. Now, unfortunately, he passed away, so maybe he never cared about it, and so he didn't live long enough to care about it. But obviously, some of the people at CNBC are going to start caring about it eventually. But everybody should have been caring about it all along. But what's happening right now is a warning. And, you know, what Donald Trump said in front of the whole world, and he didn't just say it in front of the world, he said it in Europe, in Switzerland, right? You know, where the dollar is about to crash to a new all-time record low against the Swiss franc. And he talked negatively about Switzerland as if, you know, the only reason the Swiss economy works is because of America, right? That if America wasn't here buying their watches and buying their chocolates or buying their pharmaceuticals, they'd have no country, right? This is what this guy actually believes, right? And he told everybody in Europe that Europe is nothing without America. Canada is nothing without America. We make the whole world work. Well, Trump is about to find out the hard way that that's not the case. Because if I was, you know, a central banker or a leader in any of these countries, I would be like, what the hell? Are you kidding me? And I would be, you know what? We are just yanking, the rug out from under this. We are not going to subsidize your economy anymore. We are selling our dollars. We are selling our treasuries. You think we need you, right? We're better off without you. And they are better off without us, right? They're better off consuming what they produce, not giving it to us. They're better off investing their savings productively, not loaning it to us so that we can squander it on consumption and government.
Recent geopolitical rhetoric has accelerated a quiet shift already underway. When global leaders hear that their economies depend on the United States, the rational response isn't gratitude, it's diversification. Central banks don't react emotionally, they act strategically. Selling dollars and treasuries isn't retaliation, it's risk management. The dollar's decline against currencies like the Swiss franc is a signal, not noise. For decades, the world financed American consumption. That arrangement is being reconsidered, and once confidence cracks, reserve currency transitions tend to move faster than expected.
So Trump basically waved a flag, which is what I said on my podcast, and started the race to get out of the dollar. That's what I said. That's what I titled my podcast. And that's exactly what happened today. The race is on, right? And, this is going to be a marathon, right? There's a long way to go. And gold and silver have been rising even with a stable dollar. But now that the dollar is not stable, now that the dollar is falling, gold and silver prices can rise even faster because now they've got, this tailwind coming from a weakening dollar. This is also, again, strengthening all the commodities. You're going to see that more in energy, in agriculture. That's going to be very problematic because what has Trump been, kind of hanging his hat on to claim that we have no inflation? Oil prices, $1.99 gasoline, which I guess there's some gas station somewhere in the world that's selling gas at $1.99. I've never seen it, but apparently Donald Trump knows where it is. But he's talking about these low gas prices. Gas prices are going to be going up. In fact, natural gas prices were up like 70% this week because of the storm that's coming through. But the fact that they can move like that is an indication of what could be happening in the energy sector. But today was also a big oil rally, but that is going to completely, let the air out of that balloon. And the one thing that Trump has had to claim, we have low inflation, is going to go away. But of course, he'll come up with some other lies to try to talk about how strong the economy is as it's imploding. But this is a huge game changer, right? The monetary order is being changed. We are leaving the U.S. dollar standard exactly as I've been forecasting that we would, right? When
a weakening dollar doesn't just lift gold, it fuels commodity inflation. Energy, agriculture, and raw materials respond quickly. Recent volatility in natural gas and oil markets highlights how fragile price stability has become. Inflation narratives anchored to temporary price dips ignore structural currency pressure. As commodities rise, claims of low inflation become harder to defend. This isn't cyclical, it's monetary. When purchasing power erodes, hard assets reprice upward. Gold and silver benefit first, but the ripple effects spread across the entire real economy, reshaping costs, wages, and consumer behavior.
Nixon took us off the gold standard, right? The world continued to accept the dollar as the reserve, despite the fact that it was no longer backed by and redeemable in gold, which was the only reason it became the reserve currency. It was because we had so much gold that Bretton Woods agreement, we were able to have the dollar as the reserve currency. But we went off the gold standard, but the world continued to accept the dollar as if it were still backed by gold. Well, the significance of what's happening now is that the world is now going off the dollar standard. They should have done it back in 1971, but they didn't. And that's what enabled over 50 years of this, service sector bubble economy to be created, where we will able to live beyond our means, consuming what we don't produce, borrowing what we don't save, thanks to the reserve status of a fiat currency that we created out of thin air. And Trump just went around the world telling everybody how they're nothing and we're everything and we're the greatest country and we're the strongest country and we have this huge military. And, I was thinking about invading Greenland and taking it over. But, I'm a nice guy, so I won't do it. But I could do it if I wanted to, and I may do it. You never know, right? And the only reason that we're in a position to do this is because the world pays for it. See, Donald Trump thinks America pays for everything. He keeps talking about how the rest of the world doesn't pay its fair share, and we're covering all the costs. Well, where do they think America is getting its money? It's borrowing it from the very nations that he accuses of not paying their fair share. We're borrowing a fortune from Europe. We're borrowing a fortune from South America. We're buying it from Asia. We've borrowed a lot of money from Japan. They're about to be cashing that in. The Japanese, I think, are about to be selling a lot of U.S. treasuries to pay down their own debt because their debt is getting a lot more expensive now with yields surging in Japan. So this is a very significant event that is taking place. Very few people seem to appreciate the gravity of what's going on. I mean, yes, you're seeing it now in the gold and silver market, but most people don't get what it means.
Unlike 2008, the next financial crisis won't be global. It will be centered in the United States. The problem isn't toxic debt defaults, but currency dilution. Treasury bonds won't fail. They'll be inflated away. Foreign holders will exit quietly, exchanging bonds for dollars, then dollars for real assets. Emerging markets, long burdened by supporting U.S. consumption, may finally see relief. As capital reallocates, gold and silver move from fringe assets to institutional necessity. This shift has only begun, and once allocations become mandatory, the repricing could be swift and historic.
Right? But they're buying now, and they're starting to buy, and money is starting to move in to gold and silver mining stocks. This is just the beginning, right? Because most investors have zero exposure, right? Now, in a few years, I think just about every institutional investor, all the pension funds, all the endowments, all the mutual funds, they're all going to have allocations to precious metals, whether it's some physical precious metals, mining stocks. Everyone's going to have it, because if you don't have it, you're going to underperform, right? Nobody wants to go out on a limb like I do and like be the first one to buy these stocks, right? Because if they don't work out, right, they look like a fool and they get fired, right? But what happens is once these stocks start performing, then if you don't buy them, you look like a fool and you get fired. So there's going to be all sorts of pressure on money managers to start allocating towards gold and silver, towards mining stocks, and get into foreign stocks and get out of the dollar. But what's going to happen, and this is an important point that you got to grasp, because we're headed for a crisis worse than 2008 for America, right? The 2008 crisis is called the global financial crisis, right? This crisis that's coming is not going to be global. It's going to be American. Now, the '08 financial crisis was made in America, right? But the problem was we had exported all of our bad mortgages all around the world. So when the mortgages went bad, foreign creditors that owned those mortgages also had losses. But what created more problems for the global economy was that when the financial crisis hit, the dollar was at an all-time record low, and it had a big rise. And that rising dollar, right, was a big problem for the rest of the world. This is going to be the opposite of that. This crisis is a dollar crisis, and it's hitting when the dollar is relatively high and has a long way to drop. Now, it's already dropped against the Swiss franc, but if you look at a lot of other currencies, the dollar is still high compared to where it was in 2008. And as the dollar falls, that's going to be a big positive for the rest of the world. Meanwhile, the bonds that are going to be crashing now are treasuries, and there isn't default risk there. See, there was default risk in mortgage bonds. There isn't really going to be default risk in treasury bonds. There's just going to be inflation risk. And so foreign central banks and foreign holders of our currency are just going to sell these bonds. The Fed's going to buy them if nobody else wants to. And if the bonds mature, well, they get their dollars. They get paid, right? The government's going to pay. And then they take those dollars and they're going to sell them into the market. And so this is a U.S. financial crisis. For the rest of the world, there's going to be a boom. It's going to be a bust in America and a boom, particularly in the BRIC nations, the emerging market economies that have been shouldering the lion's share of the burden of supporting the U.S. consumer, right? They're going to be relieved of that burden. They're going to see the value of their savings and their paychecks go way up, which means the cost of all the goods that they buy are going to go way down, and consumption is going to go way up outside the United States as it implodes. You know, a lot of people, when I talk about how we're going to have this massive recession, depression, and rising prices,